I've mentioned Peter Lynch over and over again in my videos. The lessons I got from following his teachings are very helpful, especially when I was just starting out in investing. His book, One Up on Wall Street, were one of the first books I've read about investing, and it gave me a good foundation as to what mindset and approach I should have in stocks. Now, if you don't know Peter Lynch, he managed a Magellan Mutual Fund at Fidelity Investment between 1977 and 1990. He had an average annual return of 29.2%, more than double what the S&P 500 made, which made it the best performing fund in the world at that time. To give you a clue of just how much money you can make from that 29.2% annually, if you invested $100,000 to that fund in 1977, you would leave with $2.8 million in 1990. Imagine, just 13 years and you became a millionaire. So Peter Lynch is one of the best investors out there, like Warren Buffett and Charlie Munger. It's practically wise to learn from this guy, which is what I'll be sharing with you guys today. But before that, I would appreciate it if you show your support by clicking the like button and subscribing. Now the first lesson is, never invest in any idea you can't illustrate with a crayon. I think you've heard the term, invest in your circle of competence. With this in mind, if you're having a hard time finding where to put your money, then you can already filter it out properly by just investing in the things you know and understand. This not only relates to stocks, may it be other forms of investment vehicles such as mutual funds or even venturing into some sort of partnership. You got to know what you own and why you want to own it. If you can't explain it to yourself or illustrate it easily with a crayon wherein a child would understand you, then by all means you shouldn't own that. By having a clear understanding of what you will invest in, you can avoid taking any impulsive decisions. If you see that company is great, then go invest in it. But if after researching that company and it doesn't suit your investing ideals, then throw it in the trash. This is by far the easiest way to filter out stocks and avoiding big mistakes which can cost you a lot of money. And by doing this, if the stock you own suddenly falls in price, you wouldn't panic, and sometimes you would even be happy that you can buy more shares. Now this actually brings us to our next lesson. The most important organ in the body as far as the stock market is concerned is the guts, not the head. Well, this is good news for a lot of us because you don't need to be smart to be successful in stocks. In fact, did you know even a monkey can beat you if it was trained to just ignore fluctuations of the market and just diligently invest in a stock market index? Because by investing in the index alone, you already beat a lot of expert analysts and traders out there. But what if you invested in the index, which is proven to have a good long-term track record, but every time the stock market takes a downturn, you panic sell your shares? Then it's useless. Even if Peter Lynch or Warren Buffett gives you the exact formula or even stock picks, you would fail if you don't have the stomach to ignore the big drop during a market crash. This is what separates a lot of investors from successful ones. No matter how good your strategy is, you have to stick with it no matter what market cycle you are in. This is also connected to the first lesson. If you don't have a complete understanding of the companies you own, then you would definitely panic when the market drops more than 20%. But those who have the stomach to take it in would even buy more shares during the drop, which is the best time to make more money in stocks, not only for capital gains, but same for getting good dividends. When stocks drop, the higher the yield companies give. Remember, market crash and corrections is the best opportunity to make more money. Now before we go to our next lesson, a platform that can help you analyze companies and track your portfolio is simply Wall Street. This gives you an update on the stocks in your watch list, from dividends, earnings, and even insider buying. And they have tons of data from different companies all around the world, which can help us follow our first lesson of never invest in any idea you can't illustrate with a crayon. With how they present their data, it's so easy to understand. So if you want to level up your investing journey, then try this platform now. They have a forever free basic plan, and if you sign up using my link, you get a 14-day free trial of all their platform's features. And not only that, if you decide to avail their plan, you also get a 30% discount by using my link. So what are you waiting for? Try Simply Wall Street. Anyway, the third lesson is so simple. The best stock to buy is the one you already own. Well, as mentioned earlier, you got to know the stocks you own. So with you already owning the stock, I think you've already done your homework with it. Warren Buffett also has a similar thought about this. Why invest in your fourth or fifth best idea when your first or second is so much better? So try concentrating on the companies you've already researched. It's much easier, especially if those companies are still trading at a very low price. Now some may question Peter Lynch with this quote. Didn't Peter Lynch own 1,000 stocks? Well, he did his research on all those companies he holds, which I think most of us can't do. So have a portfolio of companies you know well and should be able to keep track of all of it. There's no definitive rule as to how many stocks you will own. If you think you're Peter Lynch caliber, then go. Or if you're Warren Buffett-like that can concentrate his portfolio on a few stocks, it's all up to you. But always remember your limitations. Fourth, nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you've invested. If you're new to investing and are always listening to what analysts, some news channel or page out there are saying about what the market or the economy will do in the coming days, months, or even years, then you're wasting your precious time. These are all noise. Peter Lynch exaggerates this, that investors shouldn't worry about the stuff that you cannot control and focus on the fundamentals of the companies you own. If the company you own has a good foundation, then it has a big chance to weather any storm. So think about it. You can waste a lot of time trying to find out where the stock market is headed, or you can spend that time finding out what's happening to the companies you own or the companies you may want to buy. Do not try to control what you cannot control. This will just lead you to overthink and may even lead you to make irrational decisions such as panic buying or selling. Fifth lesson, if you invest $1,000 in a stock, all you can lose is $1,000, but you stand to gain $10,000 or even $50,000 over time if you're patient. What a lovely quote. If you don't see the beauty in one sentence, then let me break it down for you. The first lesson here is losing only what you invested. This already gives us a big no on trading using leverage or borrowed money. Some people try to risk their lifelong saving in scammy investments because it promises a huge return in the end. But the sad thing about it, if they are wrong, they can even go broke, plus with debt on hand, doubling or even tripling their loss. The second lesson in this code, if you're right in the companies you choose, even without using leverage, you can multiply your money a lot if you're patient enough. Remember the term, patient. A lot of investors lose their focus when the stocks they own don't move for quite some time and end up selling them too early. But making money in investing isn't a one-day millionaire scheme. It will take years to compound your money. If you're thinking about being rich in just months or 1 or 2 years, then stocks aren't for you. Some of the best stocks of Peter Lynch took 3 years and some even 5 years to give him good returns. The problem with most people, they want their money very rapidly, which doesn't happen most of the time. So whenever you're investing, always have a long-term mindset. That's why you got to know the companies you own and ask yourself, is this worth it to hold on to for a long time? This way you can survive and be patient enough to wait for your money to compound over the years. With that, this ends this video for today. I hope you've learned something, and if you did and still haven't clicked the like button, then I'd appreciate it if you do so before leaving. So thank you and see you in the next video.